Welcome to our video on the basics of index funds. In this video, we'll be covering everything you need to know about index funds, from what they are, to how they work, and why they're such a popular investment choice for many investors. Whether you're a seasoned investor or just starting out, understanding index funds is crucial to building a diversified investment portfolio that can help you achieve your financial goals. So let's start with the basics. What are index funds? Simply put, index funds are a type of mutual fund or exchange-traded fund (ETF) that tracks a particular index, such as the S&P 500 or the Nasdaq. These indexes are made up of a group of stocks or other assets that are selected based on certain criteria, such as market capitalization, industry sector, or geographic region. By investing in an index fund, you're essentially buying a small piece of all the companies or assets that make up that index. Index funds are designed to provide broad market exposure, diversification, and low costs, making them a popular investment choice for many investors. Now that we know what index funds are, let's take a closer look at how they work. Unlike actively managed funds, which are managed by a portfolio manager who tries to beat the market by buying and selling stocks, index funds simply track the performance of a particular index. Because index funds are passively managed, they have lower fees and expenses compared to actively managed funds. Another advantage of index funds is that they provide diversification by investing in a broad range of companies or assets. This helps to reduce the risk of investing in just one or a few stocks or assets. So why are index funds so popular among investors? First, as we mentioned earlier, index funds offer broad market exposure and diversification, which helps to reduce risk. Second, index funds have lower fees and expenses compared to actively managed funds, which can save investors money over the long term. Third, index funds are easy to buy and sell, making them a convenient investment choice for many investors. Now that we understand the basics of index funds and why they're popular, let's talk about how you can invest in them. The easiest way to invest in index funds is through an online brokerage account. Many brokers offer a wide range of index funds that you can buy and sell at any time. Before you invest in any index fund, it's important to do your research and understand the fund's investment objective, fees, and performance history. You'll also want to consider the fund's diversification, risk, and asset allocation to make sure it's a good fit for your investment goals and risk tolerance. If you're not comfortable choosing index funds on your own, you may want to consider working with a financial advisor who can help you build a diversified investment portfolio. Finally, let's talk about the differences between index funds and actively managed funds. As we mentioned earlier, index funds are passively managed and simply track the performance of a particular index. Actively managed funds, on the other hand, are managed by a portfolio manager who tries to beat the market by buying and selling stocks. While actively managed funds may outperform the market in some years, they also have higher fees and expenses, which can eat into your returns over the long term. Additionally, actively managed funds can be less tax efficient than index funds since they have higher turnover and capital gains distributions. Ultimately, the decision to invest in index funds or actively managed funds will depend on your investment goals, risk tolerance, and personal preferences. Remember to always do your research and consult with a financial advisor before investing in any index fund or other investment product. When it comes to investing in index funds, there are a few key steps you'll need to follow. First, you'll need to choose an online brokerage firm that offers index funds. Once you've chosen a brokerage, you'll need to open an account and fund it with money you're willing to invest. Most brokers offer a variety of account types, including individual, joint, and retirement accounts such as traditional IRAs or Roth IRAs. After you've opened your account and funded it, you'll need to decide which index fund or funds to invest in. As we mentioned earlier, there are many different index funds to choose from, each with its own investment objective, fees, and performance history. Before you invest in any index fund, be sure to read its prospectus, which will provide you with important information about the fund's investment strategy, fees, and risks. You can also use tools provided by your brokerage to compare different index funds and their performance histories. When choosing an index fund, you'll want to consider its diversification, risk level, and asset allocation. For example, if you're investing for retirement, you may want to choose a fund with a more conservative asset allocation that includes a mix of stocks and bonds. Once you've decided which index fund or funds to invest in, you can buy shares through your brokerage account. Most brokers allow you to buy and sell index fund shares at any time, which gives you flexibility to manage your investment as needed. Remember to periodically review your index fund investments and rebalance your portfolio as needed to ensure that it remains in line with your investment goals and risk tolerance. Finally, it's important to be aware of common investment mistakes that can impact your returns and overall investment performance. One common mistake is to invest too heavily in a particular stock or sector, which can increase your investment risk and potentially lead to significant losses. Another mistake is to try to time the market or make frequent trades in an attempt to beat the market. This can be difficult to do, and can result in higher fees and expenses that eat away at your returns. Finally, it's important to avoid emotional investing decisions, such as buying or selling stocks based on fear or greed. Instead, focus on your long-term investment goals and stick to a disciplined investment strategy. By investing in index funds, you can gain exposure to a broad range of securities and potentially achieve market-like returns with low fees and expenses. However, it's important to remember that investing always involves some level of risk, and it's important to have a clear investment strategy that aligns with your individual goals and risk tolerance. Thank you for watching this video on the basics of index funds. We hope you found it informative and helpful in your investment journey. As always, remember to do your own research, consult with a financial advisor if needed, and invest wisely. If you have any questions or comments about the information presented in this video, please feel free to leave them in the comments section below. And if you found this video helpful, please give it a thumbs up and share it with your friends and family. Remember to subscribe to our channel for more informative videos on personal finance and investing. Thanks for watching, and happy investing!